Hello, David Moore with Equity Advantage, here with Robert Smith of Peregrine Private Capital, and we're talking Endgames today. We're talking about a variety of things. We typically talk about DSTs, but we're doing a little bit of that, but we're talking about sort of other things off your menu of opportunities, and I like to say opportunities that are out there.
Plural.
Yes, definitely. So we finished up the last segment talking about a little bit about 721 UPREITs, and do you have any other comments on the UPREITs, and if somebody was interested in it, things people ought to consider if they're looking at that space?
Yeah, I think, again, it's a great exit strategy, but what investors need to understand is that all UPREITs are not created equally. Their performance ultimately is going to be dictated largely by the property composition of the portfolio. So you, as a potential investor in an UPREIT, before you pull the trigger, have to really drill down on the portfolio and ask yourself the questions: what types of properties are in this portfolio, and how do I think those properties will perform in our current inflationary environment? So you have to look at you have to understand not just the 721 UPREIT structure and how you get there, but you also need to have a profound understanding and appreciation for the composition of that portfolio and come to a decision, your own decision, as to whether or not you think those properties will perform well in the current and future inflationary environment.
So you got to look at the sponsor.
Yep.
And you got to look at the ultimate product. It's like buying any other stock or making any other investment. Understand what you're ultimately going to buy then.
You're exactly right. It's not a blind pool. All of these UPREITs, or most of these UPREITs, already have an existing portfolio of properties that are throwing off cash flow. So you need to look at the composition of those properties and extrapolate from that in terms of future performance.
And there's a pretty finite number of sponsors in that space, too. I mean, it's not like it's readily available to people. You've got to talk to somebody that understands what's there and is going to have access to those products.
Correct.
Got it. So we've talked a little bit about DSTs today. We talked about UPREITs. What other sort of end games do you have for people that people might be aware of or may not be aware of but might have some interest in?
We get lots of questions with regard to opportunity zones, Oz funds, because it's topical and it's another option to defer capital gains tax liability. And without going into too much detail, the fundamental difference between, at least from a composition standpoint, between DSTs and Oz zones is Oz zones are generally, or Oz funds, opportunity zone funds, are generally development projects. You know, they're either building something out of the ground or they're rebuilding something that's already on ground. So it's a development project. And as a development project, there's obviously more risk incumbent in it as opposed to DSTs, which have to be fully stabilized cash flowing assets. So you do have the added risk component of development, and because it's a development project, there usually isn't much in the way of cash flow associated with the early years of that opportunity zone, because they're building something up, then it has to be tenanted, and then the cash flow may start. So they both can help to defer capital gains tax. However, the majority of our investors need cash flow from that asset because it's usually an important part of their retirement planning. And generally speaking, one provides a predetermined level of cash flow. The other, at least initially, will not.
Interesting. So I sort of tongue-in-cheek say, I don't like them. And the reason I say that, and I say tongue-in-cheek, he's laughing, I'm laughing, is that I lost personal property exchanges when they came into play, and I'm sure that's why, right? Yeah. So we lost personal property exchanges because they were the 1%ers doing the cars and the artwork and everything else I talked about earlier. And that's why I say that I don't like them. With that said, if people would like to know more on the structure and how they work, I sort of look at them as a Roth IRA. You got limited tax deferral into this thing, and if you hold it for the whole time, the gain on that asset is tax-free, right. Sort of like a Roth IRA. Right. If you'd like to know more about the UPREIT process, check out Equity Advantage, type in Equity Advantage, OZ, our Opportunity Zone, and there's a whole series there with Connie Rathbone, a lawyer that specializes in this stuff. She did a great job, great series, and actually we're going to have an updated one that we're doing in the next couple of weeks with that. So if you're curious about the structure, watch those things. If you want to buy one, give this guy a call, all right? And I think, once again, it's a great place to diversify. I think that's sort of a little bit where you were sort of alluding is, hey, it's another thing to consider. It's another place to put your money if you want to have some separation and stability, maybe, right, over time?
Yeah, I think the key there you just mentioned is diversification, and whether it's a portfolio of DST properties, integrating opportunity zone fund into the mix, and or a 721 UPREITs, all of those vehicles allow you to diversify over different asset types or different properties in different geographic locations with different functions. And we think at this very advanced point in the asset pricing cycle, meaning stocks are high, everything's high because the world's awash in liquidity and the Fed is still pumping money into the system. Yeah. So, the stock market probably has, it's got some time left to wallow in this, as do other asset types. But sooner or later, there's going to be a day of reckoning. And because of the very advanced nature of this process, we think diversification, functionally, geographically, is your very best friend in terms of hedging against the inevitable principal loss that will occur when the economy slows down and as interest rates go higher. So we think at this point in time, diversification is your very best friend, and these different asset programs allow you to more easily diversify than you can probably otherwise do yourself.
So it is a development play. Mm-hmm. So the investment tax deferral is only good if you're getting something that's going to be there. And as far as when this whole process started, I saw a whole bunch of old, stale development projects that had been stillborn that suddenly became very attractive because of this new tax deferral deal. So I know you've been working in the DST and institutional real estate space for decades. And I know you work with some great sponsors, and I just would like to, sort of give you the opportunity to, talk about, once again, I think it's a great option, it's a great opportunity, but work with somebody that's going to be there, right? And so the people you're working with in that space.
Well, it's again, these mechanisms, these investments allow you to diversify in an extremely efficient manner. That being said, you're handing the keys to somebody else. So somebody else is going to be driving the bus. And income property investors historically tend to be very controlling personalities. And so getting over that hurdle in terms of, I'm not going to control this anymore. I'm going from the, I manage tenants, manage managers who manage tenants, to the mailbox money business. That's a big deal, okay? And because it is a big deal, you've really got to do your due diligence on who that bus driver is going to be. Your product sponsor, your developer, your property manager. We like to say that when times get tough, a really, really, really good management team can help make a challenge property work. A really bad management team will usually, will oftentimes destroy a good property. So you have to know who your management development team is, what their track record is, and if they've been through the fire, and if they have, how well did they perform when they went through the fire. So a DST is only going to be as good as the management team that's driving it, and an opportunity zone is only going to be as good as the developer that's driving that. So you don't just jump in the deep end of the pool without doing serious due diligence on who is going to be responsible for the success of your hard asset.
Definitely. So this is put out sort of as a 1031 exchange fallback sometimes.
Yeah.
And I want to stress, number one, OZ has nothing to do with the 1031 exchange. You're just going to make the investment. So it has nothing to do with the 1031, but it does have the same 180-day timeline. So in a market as we are currently experiencing, it's that 45 days is brutal, right? And as far as 1031 G6 is concerned, 1031 G6 is the guidelines that we have to work within to release funds from your exchange. So if you have a quote unquote failed exchange, what I'm going to tell you is when you get to that 45th day, if you want to go talk to Mr. Smith about an OZ, on that 45th day, you better only identify what you plan to buy. Anything else should be omitted. If you're working with us, our ID form has different identification options there, and then down below them it says that you reserve the right to buy X of those things. So if you're IDing, let's just say the most basic ID rule is a 3-property rule, and you're IDing 3 properties with the intent to buy one, you're going to put one in that blank. And after you've purchased that one property, if we're outside the 45 days, then we can give you the balance of your money, and you can go talk to Bob about throwing the money into the OZ. If you don't do that, you ID 3 properties and you only close the one and you've got the money that was reserved for the OZ, I can't give you that money until day 181. So you're going to have to either come out of pocket that money to make the investment, or it's just not going to happen. So I think it's really critical if you're in an exchange in today's world that you understand 1031 G6, and it's not my company policy. Anybody in the exchange business that treats this business with integrity is not going to allow money outside of 1031 G6, and it's really important you're working with a team of professionals that are going to understand and give you the ability to get where you want to go. So, to work with some exchange company just going to handle paperwork and not give you any guidance is really not someplace I think you ought to be in today's world. There's lots of things out there. That's why we sit and talk about these options. And you need to be working, if you're looking at investments, work with an investment provider that's going to give you these options and get people where they want to go. And I think you do a great job of that. You've been doing it for a long time. So, once again, the OZ is another option, but you got to let the people know in your life if you want to do it so they can make sure that you've got the opportunity to get there.
That, you're exactly right. And the emphasis should be on doing as much homework as early as possible, because there is a degree of ambiguity in Section 1031 of the Internal Revenue Code. You need to understand that. You need to work with someone that understands that and appreciates that and is in a position to counsel you with regard to that, and not just push papers and charge a fee. So there is a very real difference in the qualified intermediary space, just as there is a real difference in the DST and opportunity zone space between property and project providers. So the sooner you start doing your homework with regard to that, the greater the likelihood is you will ultimately make an optimal decision.
Great. Well, it's been fun today.
Yeah.
Always is.
Fun. Yes, buddy.
Always is.
Yeah, bro.
I would like to throw it out to the audience out there that if you've got a topic that you're interested in and you're not finding it, please reach out to Bob or myself, and we'd be happy to try to provide content that's going to address your questions. And I always like to say the only dumb question's the one that's not asked.
No question.
It's a complicated world out there, and if we like to say, you've worked hard for your money, we work hard to keep it yours. And and in days like we're in today, it's hard to do that. And keeping your money's actually a big mistake. So you better be, putting it into things that are going to help you get through this period of time.
Yeah.
And I would say hard assets are the way to do it. And just want to thank you very much for the time again today. David Moore with Equity Advantage here, and hosting Robert Smith of Peregrine Private Capital. Any words to send them off with, Bob?
Just, hard assets are good assets. And, you've waited for your ship to arrive for a long time, and it's here now. So for God's sakes, don't jump overboard. Okay?
Definitely.
You've got the right type of asset for the current environment.
That's great. Well, thank you. It's been fun. Thank you, everyone. And look forward to seeing you again soon. Take care. Bye-bye.
Bye-bye.
I know you didn't in my heart. You didn't even read my story. Good girl, good these stars. I can see straight